Hello, fellow investors. Still with restaurant stocks. I'm screening 4 stocks this time, namely ARMK, ARMK CBRL, Cracker Barrel Old Country Store, DENN, Dennis, and Play, Dave and Buster's Entertainment Inc. 3 of them I'd avoid, and 1 of them I'd recommend buying. First one I'm screening is ARMK, Aramark. They provide food service, facilities, and uniform services for healthcare, business, prisons, and leisure. This is their valuation summary. I hope you've watched my previous videos. ARMK is overvalued in our metrics. EPS is too low, 0.57, and the PE is too high at 58.9, making a 103.33 EPS multiple. Is the EPS always this low? Well, no. The highest in 5 years was 2.24, but even if we use that, it wouldn't change anything. Let's look at their margins. Very low margins, playing around 1 to 3%, even negative sometimes. Free cash flow is poor compared to market cap. Historically expensive too. PB ratio is good though, 2.96. Very low attractive. Current ratio, 1.14. Everything else is bad for ARMK. Now, why does it trade like this? This is what I mean by a moat multiple. When a company is maybe like a monopoly or a duopoly or probably the pioneer in the industry or sector, investors tend to value this company very highly. But I look at stocks the same way. I leveled. ARMK must trade at low PEs. I have fair value for the stock less than $1, a penny stock. Intrinsic value of $3.61. This is from Guru Focus. I have high price of $1.71. This is easily in my avoid list. Don't buy the stock. Next stock is CBRL, Cracker Barrel Old Country Store, an American chain of restaurants and gift stores. This is CBRL valuation summary. Again, overvalued, trading at 3 times their margins. Their margins play around 4 to 8% margins. Nice dividend yield though, I love it, 5%. EPS is down now. Can they bring back the 10 EPS? Price to free cash flow is attractive at only 11.06. I could be in CBRL for trade. PB ratio looks promising too, 3.96 only. But current ratio is bad, 0.64 for the quarter. Strong cash position for CBRL as well. Overall, still overvalued. Even if I use 10 EPS here and 8 for 8% margin, $80 would be the highest price for CBRL. But again, it's not worth $80 now because the EPS is lower now and the margins. We don't use the highest, of course. I have fair value for CBRL at $33.21. Guru Focus intrinsic value of $83. The same price around when EPS was 10 and margins were 8. Very logical. I have a high price of $36 for CBRL, so obviously it's overvalued and I'm not a buyer of CBRL. Maybe I will at some point. I'm liking the dividends, maybe when the fundamentals get better and when they regain that 10 EPS back. Third stock is Play, Dave and Buster's, an American full-service restaurant and entertainment business. This is Play's valuation summary. Overvalued, 7.81 times EPS multiple. The EPS is always this low. The PE is overcompensating for the low EPS. No dividends, 48% of the highs. The margin plays around 4 to 10%. Very attractive price to free cash flow too, 9.69 only. PB ratio is high, 6.73. I want this below 5. Current ratio is 0.47. It should be above 1. Strong free cash flow, but very poor in cash. I have fair value of $18.5 for Play. Intrinsic value from Guru Focus $15.5. I have a high entry price of $13. I think it's a growth stock. At least it's treated like one. Um, High revenue growth, almost 10% yearly. But again, this is overvalued, so I don't recommend buying this stock. Fourth stock is obviously the buy of the four, and it's Dennis, DENN stock, an American table service diner style restaurant chain. Well, it's not technically a buy, but it's trading around fair values now. If you compare this to the other three, I think the chances of me buying DENN is higher than the other three. Fair value is around $9. Intrinsic value is $4.8. This is from Guru Focus. High price of $7. Not very far from the current price. 58% off the highs. EPS is growing. They're buying back shares. No dividends though. Margins are considerable, playing around 8 to 16%. Price to free cash flow is good too, 12.46. Historically, it's cheap too. Too bad the equity is negative, implying a very high liability to asset ratio. I have here a table comparing the four of them so you can decide for yourself. I'm going with DENN, Dennis, but if you think DEN is not the play for you, well, it's up to you and your investing process. Let's look at their charts. Actually, it bounced around $9. Is it the bottom? Obviously, I don't know, but if you're okay with DCAing with this kind of stock, I think adding to existing positions at $9 would be fine. So yeah, that's my take on the four stocks. See you in my next video.